In 1998, two Nobel Prize winners almost toppled global finance with math alone. You feel the irony when brilliance and catastrophe intersect in a quiet Manhattan office. The hook here is simple and unsettling. Perfect equations were about to meet messy reality. What happens when the smartest explanations in the room start to fail spectacularly? You need to understand the founders to understand the danger they brought. Long-term capital management was founded in 1994 by John Meriwether, a Salomon Brothers trading legend who knew how markets behaved in good times. You should picture a firm built on elite pedigree and confidence. That numbers could tame markets. You will be stunned by who they recruited to that office. Myron Scholes and Robert Merton, who would win the Nobel Prize in economics in 1997, lent intellectual legitimacy and mathematical rigor to the fund. You can already feel the gravity of computation and prestige concentrating in one place. You should imagine a team that read like a who's who of finance and academia, former traders, mathematicians, physicists, and derivative specialists, crowded a glass-walled Manhattan room and believed they had solved market inefficiency. You can almost overhear them speaking in probabilities and elegant formulas that promised consistent returns. You need to know their strategy to see how fragile it really was. LTCM specialized in relative value arbitrage, betting that similar securities would converge in price over time in fixed income markets. You should picture thousands of small bets stacked together with the assumption that market relationships revert to historical norms. You are about to see why their math felt bulletproof, and then why that feeling was misleading. LTCM employed sophisticated models like Black-Scholes, variance, and proprietary risk algorithms that assumed normal distributions and stable correlations. But here is where it gets interesting, because markets do not always behave like neat probability curves. You must grasp the scale that turned elegant bets into systemic threats. The firm routinely used leverage approaching 40 to 1, creating positions rumored at roughly $125 billion on less than $3 billion of capital. You should feel the vertigo of enormous positions resting on a thin cushion of equity and confidence. You will appreciate why early returns fed the hubris that followed in predictable fashion. Between 1994 and 1997, LTCM produced astonishing yearly returns, often above 40%, which made risk appear optional and genius look infallible. You are watching how success becomes a narcotic that dulls caution and amplifies conviction. You should understand the quiet blind spots that lurked behind those glowing returns. Much of LTCM's conviction came from historical simulations that assumed markets were stationary and well-behaved, which underestimated the possibility of extreme events. You are about to see how a single foreign shock would expose those assumptions as dangerously incomplete. You need context about a volatile late -1990s global backdrop to see the danger clearly. Emerging markets were under stress in 1997 and 1998, with contagion spreading from Asia to Russia and beyond, and investors were skittish about sovereign credit risk. You are watching a world where local shocks had the capacity to morph into global avalanches. You remember the date because it is the moment theory collided with chaos. In August 1998, Russia announced a default on domestic debt and let the ruble float, triggering a violent repricing of risk worldwide. What happened next will shock you because the models that promised stability suddenly had nothing to say. You feel the first tremors through widening credit spreads and frozen markets that no model anticipated. Hedge funds and banks began to reassess positions overnight, and liquidity evaporated in markets LTCM depended on for orderly exits. You are witnessing how a few broken relationships can cascade into a market-wide panic. You should grasp the scale of LTCM's exposure as losses mounted without mercy. Over 4 months, the fund lost roughly $4.6 billion, turning its celebrated profits into staggering red ink. You can feel how quickly previously contained risks balloon into existential threats when leverage amplifies adverse moves. You will understand why counterparties began to worry about contagion and counterparty risk. LTCM's notional derivatives exposure approached $1 trillion, tethering dozens of major banks and brokers into an interdependent web. You are watching how the size and opacity of those positions made regulators and bankers very uneasy about systemic consequences. You witness the mechanics of a market-forced exit when counterparties pull back and demand collateral. Banks tighten lines and refuse to roll over trades, leaving LTCM scrambling to unwind gigantic positions into illiquid markets. You can almost hear the desperate negotiation and the sound of prices moving against concentrated sellers. You should see how leverage transmutes a manageable loss into a crisis of liquidity and confidence. Forced selling widened spreads, which created further margin calls and a bleeding spiral that no algorithm foresaw. You are beginning to understand why those in power saw LTCM as a problem far bigger than a single hedge fund. You must appreciate the gravity of regulators watching a potential chain reaction across global markets. The Federal Reserve in New York concluded that LTCM was too interconnected to fail without risking broader market stability. You are about to see how private banks stepped in under public pressure to avoid a systemic meltdown. You will be surprised by how the rescue was structured as a private solution to a public risk. 14 major banks and broker-dealers organized to provide a $3.6 billion recapitalization, coordinated at the Fed's behest, and without public funds. You are watching a negotiated lifeline that aimed to unwind positions in an orderly way, rather than spark panic with disorderly defaults. You should note that this bailout was not a permanent salvation of LTCM's strategy. The banks injected capital, took control, and essentially dismantled the fund's positions over time to limit market disruption. You are seeing a pragmatic containment that avoided immediate collapse at the cost of admitting failure of the model-driven approach. You will sense the reputational damage that followed a fall from such intellectual heights. The image of Nobel laureates tied to a near collapse became a powerful symbol of misplaced faith in theory over reality. You are looking at a moment that spawned books like When Genius Failed in a long, uncomfortable debate about expertise and humility. You need to absorb the core lessons about models and risk that LTCM left behind. Mathematical models are tools that rely on inputs and assumptions which may break during rare but severe events. You are learning that model risk, tail events, and non-stationary markets are not academic footnotes, but central concerns for real-world finance. You should also confront the lesson about leverage and liquidity that this story dramatizes vividly. High leverage amplified limited shocks into existential threats because liquidity evaporated when it mattered most, turning small market moves into catastrophic losses. You are understanding why leverage management and liquidity buffers are core to sound risk governance. You can draw a direct line from LTCM to the 2008 financial crisis and beyond in terms of complexity and shadow banking. Both episodes feature opaque instruments, massive leverage, and the illusion of diversification under extreme stress. You are invited to consider whether complexity without humility is simply risk dressed in smarter clothes. You should not forget the human elements that science cannot quantify fully in spreadsheets. Hubris, groupthink, incentives misaligned toward short-term gains, and the prestige of Nobel laureates all shape decisions inside LTCM. You are witnessing how psychological biases and cultural dynamics turned mathematical confidence into collective blindness. You need to take the LTCM story as a cautionary tale for modern quantitative finance and emerging AI-driven models. The same hubris that once wrapped itself in equations can now be dressed in neural nets and backtests, and history warns against blind reliance. You are left with the question, are we simply repeating the same error with fancier tools? You should close this story with a philosophical twist about the limits of certainty and the role of humility and expertise. Mathematics describes patterns, but it does not command markets, because markets are social constructs influenced by fear and coordination failures. If this gave you a new perspective, you understand that wisdom in finance often looks like restraint rather than bravado. You will leave thinking about accountability, regulation, and the kinds of institutional safeguards we actually need. LTCM taught regulators and market participants that private brilliance can create public fragility, and that some risks require collective solutions rather than private bets. You are now equipped to ask better questions about models, leverage, and the systemic consequences of concentrated confidence. You should remember the final practical takeaway about resilience in systems that matter to everyone. Build buffers, stress test beyond recent history. Limit concentrated leverage, and respect the unpredictable tale of rare events in markets. You are now primed to think differently about risk, not as a number, but as a social reality that must be managed with humility. If this story resonated with you, there are books and deep dives to explore for those who want more. Start with When Genius Failed for a vivid narrative, then read academic pieces on model risk and the mechanics of the 1998 rescue. If this gave you a new perspective, hit subscribe and join the conversation about how we balance brilliance with prudence.